we want lots of money, but we've got to plan accordingly. H&R Block's going to help us out. Lisa Gittins here on the BT Couch. Nice to see you.
Thank you for having me.
Let's get it out of the way. The deadlines we need to be aware of over the next few months.
So May 1st is the deadline for filing your personal tax return. Literally, that's 72 days away. No longer weeks or months, days. March 1st is the deadline if you're going to contribute to your RRSP, and that is 12 days away. So those are the 2 days, circle in big red on your calendar. You've got Valentine's Day is over with, so get your red marker and use it again.
So if we want to maximize these RRSPs and get that tax deduction, what do we need to really consider when we're planning?
Well, there's a number of things to consider this year because we've got recent tax changes for 2016 that are going to impact and really make an RRSP a prominent factor on your return. One of those changes is the introduction of a new federal tax rate at 33% for anyone earning over $200,000 in 2016. That means they've earned more money, they're going to pay more tax. Strategy for that person is before March 1st, maximize your RRSP contribution in order to save your tax bill when you're filing. The second thing that impacts your tax return and makes RRSPs more prominent is the limit. In 2015, tax-free savings account was increased to $10,000, so you could put that in. 2016, it's reduced back to $5,500. So you've got extra cash sitting in there that you may have to withdraw. And if you're going to withdraw it, perfect opportunity to put it into an RRSP and reduce your tax bill.
And now how do we determine how much we are eligible for maximizing the RRSP?
There are a number of factors, so ideally you need to sit down with a tax professional and let them look at your unique situation. In Canada, we have a self-assessment system. Everyone's situation is different, so there's no real cookie-cutter formula. In BC, I can give you this example. If you are earning, say, $45,000, and you were to contribute $1,000 to your RRSP, you can expect with that $1,000 to save $227. And for every $1,000 you contribute, that would be your tax savings. Sit down now, you've still got time. Speak with a tax professional or your RRSP advisor. Let them look at your personal situation and tell you what you should be contributing so that you can step out and purchase that contribution, make it that contribution, and use it on your tax return. You don't want to find out about these things 10 days after.
There's also the opportunity that sometimes you know there's a tax deduction available and there's the opportunity to take a loan. What do you need to consider if you want to look at the idea of taking a loan to invest in the RRSP and then get that refund back?
Very good question. The thing with the loan is you're going to use the loan from the bank. Make the RRSP contribution, and then any tax savings that you have, you're either reinvesting in the RRSP or using that tax savings to pay down the loan. So it's good to, again, talk with a tax professional, find out what you would need so that the tax savings you have is enough to repay that loan. Brings me back to the previous point. If you have cash sitting in your tax-free savings because you made that $10,000 contribution last year, take the loan from yourself. Take it out of the tax-free savings and put it into your RRSP this year. Therefore, you're maximizing both accounts.
And if you exceed the limit of what you're putting in the TFSA, are there penalties associated with that?
That is correct. If you have more than the federal requirement allows in the tax-free savings, you're going to be taxed on that additional amount according to the income tax bracket that you are sitting in. With the RRSP, you're getting a deduction for the amount that you put in. So use anything in excess in the tax-free savings account, and this is the year that it will really maximize your RRSP contribution.
How much are Canadians saving right now as you talk about people maxing out their TFSA? Because you need to have, especially with cost of living in Vancouver, a lot of savings.
It's not a good number. It's 15% of Canadians who are utilizing the RRSP, and an even smaller number utilizing their tax-free savings account. Part of what accounts for that is we've been hearing about RRSP since 1990. We've only TFSA was introduced 2009. So we're a decade behind in understanding it and how it plays out. But one key thing is this: when you invest in an RRSP, you're investing in yourself, and you're investing before you pay tax and not after. When you use the TFSA, you're investing after you've paid the tax on your income.
Great information, great tips overall, and as you mentioned, 12 days to that RRSP deadline.
Correct.
So let's jumpstart those conversations. If you have that money to put away and capitalize on those tax savings, follow along. H&R Block, great resource for us. Lisa, thanks so much.